issue which I'm sure every investor here wants to know. And that has been the beta noir of the industry, right? And that has been exits, right? Anybody who has heard of private equity has often heard a negative story to do with exits, you know? And this is becoming such an important issue to be addressed. So I'll go again across to each one of you. And here, I would love if you can, take one specific example and also touch upon when does the exit consideration start? Is it at the time of investment? Is it 1 year down the line in the investment? Or is it somewhere towards the end of the fund? So I think, and has that mindset changed? And I ask this with a lot of caution, because we have known that the vintage of 2007-8, which was marred by GFC, we've known of funds which were probably around the taper tantrum in 2013-14, which probably were supposed to mature in 2024, had to be pushed into continuation vehicles or have undergone extensions. So what has not worked as far as exits are concerned, and how is that changing, right? Sharad, I'd like to start with you, because you've had the maximum number of IPOs hitting markets. So if you can give us one example and also touch upon when did you start thinking of the exit?
So I'll say that as part of ICICI, we have seen cycles. We've been sort of into private equity investing for now last 3 decades. And we have seen good times, we have seen bad times, and exit during bad times becomes really tough, because if the momentum is going on, the good assets and the semi-good assets also sort of gets liquidated. But if you basically go through a slowdown, then that's where I'll say the test actually comes in, when how much of your assets actually you are able to liquidate. From our investment strategy, it's always there that when does the thoughts of exit come? And the first point is, when we are investing, the first question that comes in the mind of every of the team member is, how will we basically exit this asset? In any of the fast-moving assets, slow-moving assets, you are able to you just need to basically think about how the environment will be 3 to 5 years from now when you are actually liquidating that asset. If the asset has got a unique story, differentiation, and obviously some kind of a moat, you will always find liquidity for such assets. And that's why these considerations become very important when we are investing at the initial stage only. That has been the sort of a core focus of the team, and that's the reason we are able to sort of see such a good exit track record. The second point is also the price discipline, which you need to follow when you are investing into the asset, and that's also linked to the exit, because the expensive asset you buy, and your expectation will be having a multiple on that pricing. If the asset has not grown the way you envisaged, and given your higher price, it will be very, very difficult to basically, sort of liquidate with the returns. And then that's the question comes in, then you may have to take some, the loss in the profit, or maybe, a haircut in the principal. But the discipline during investing, that also basically plays a very important role. I'll just like to, highlight an example about a company called Go Colors, which we invested in 2018, and company was small, sort of 70-80 crores of revenue, and they were like into the EBO space, and we have sort of scaled that asset in the next 3-4 years, despite being COVID and all the challenges that we face across. It's an offline business. We basically took that business to 500 crores in our 4 years association with that company. And we took that company to the public IPO, and that was sort of a story which came out very, very differentiated, because you were creating a brand into a commodity, and this was much more very widely accepted, because the market is expecting there is going to be a lot more branding that's going to happen across various categories of apparel, and this was one of the first assets that came in. Now that was a differentiation where market actually priced it quite well, and that gave us a sort of a, I'll say a very, very good outcome for our investments. That thought of about exit came in when we actually made our investment in that company, and how will we basically scale this company and how will we position this company to the investors. That was something which differentiated that.
Great. Dr. Ray, seed, right? A seed growing into a plant bearing some fruits, and probably an exit later. But from your innovation experience, right? You've presided over nearly 200 PhD students. Many of them actually went on to make...
Not 200 students, but over 200 innovation
over 200 innovations,
experiences.
Yeah. And about 16 actually commercialized, 6 were blockbusters. So from that experience, how do you draw upon that on investments? Because essentially you are you end up investing in ideas which are probably very nascent, and sometimes they may not commercialize at all. Sometimes these innovations will probably have to pivot. They would probably have to, change course midway during their journey. So at what stage do you think of exits? And from Rajiv's earlier investments, if you can talk about one example.
Great. Yes. I think that is a critical question in the sense that anytime you want to make an investment in a seed or early stage, you actually have to start with what Mr. Malpani said. You must have a view of where the value will be created and where is the moat. See, if it is differentiated, if it is going to have market traction, and if you can foresee that value, at least you have a good exit hypothesis. You can still have a black swan event, but your hypothesis has to be clear on the day you invest. And that's why typically when we look at investments we're doing our first fund right now. So when we do investments, we are not looking at it, we will not get blinded by a large market size. We will get blinded by the quality of business that can be defended and validated. Right. And to extend that point, the example that we'll take from our proprietary portfolio was an investment called Vyom. Back in the late 2000s, there was a lot of talk about human skin getting affected by climate change. And Vyom actually started out on looking at how you can look at skin science and create a compelling solution to skin infections, diseases, etc., that occur because you have more microbiological activity, more susceptibility. And that company actually went through a couple of serious black swan events, COVID being one, but before COVID, there was a capital dry up. So managing partner Rajiv, he actually had to run the company himself because that was the only way he could keep management costs down. He ran it for 3 years, through the valley of death, back out of it, and I'm pleased to say that it's coming on IPO on the 15th of August in New York with the ticker HIND.
Wow, that's amazing.
Right. So I think that's a story that you have to be very patient, but in a case like this, we would have in a skin product, typically you would go IPO. I'll give you a flip product. I have chances are all of you are using it. This was one of my earliest innovation products. We made it for a small client in Pune called Crosslands Labs. And they came to us saying, every pain balm in this country is sticky and it stains your clothes. We have imagined a pain balm that will disappear on rubbing and will apply like a lotion. Can you make it for us? So we designed that product. You're probably using it. It's called Volini. It's gone through 3 acquisitions. Volini.
Volini.
It's gone through 3 acquisitions.
Wow. Excellent. Great. So coming to you, Abhishek, I mean, exit for you, I mean, you have no one else to blame, right? Because you are running the show. You are a buyout fund. So if you go back to your investor and say that, sorry, I couldn't exit it, I'm sure he's going to give you a earful, right?
No, that's never possible, and I'll tell you why. So coming to specifics here, since you talked about buyouts, we made more than 29 investments. We've exited 22 of them, and 7 we know there is a lot of value getting created.
Great.
So first and foremost, I think from a buyout perspective, as was rightly mentioned, we control the outcomes, which includes generating liquidity. Now, where are these means of liquidity? What do we do? So first, to put the context, as Samara Capital, we invest anywhere between 500 to 1,500 crores in a single check. We call it mid-market. In India is growth all around. The sectors that I mentioned, they're all growing. We don't take leverage, so we don't add to the risk profile of the business. Our main endeavor is to provide superior risk-adjusted returns. The 4 sectors that I've called out includes consumer, healthcare. These are low beta sectors, and they are growing in the economy, and with a lot of strategic value that is available to them. So for us, first it is eliminating the risk and then looking at how much returns can we generate. And the testimony to that is our previous fund where we made 10 investments. We have not lost money in any one of them. Now, if I were to talk about the avenues of exit. So for the ticket size that we operate in, we have all options open. We can take our businesses to IPO if they have done exceedingly well and if the IPO markets are very receptive for those businesses. We can do a strategic sale of the business because, again, as I mentioned, the sectors that we invest in have a lot of strategic interest typically. And there are always financial sponsors, and we classify ourselves as mid-market buyout funds. So there are also bulge bracket buyout funds, some of the names that I mentioned, multinationals who are operating in the country.
The larger funds, which
The
typically
larger,
come at the
yeah.
much later stage.
Like of Blackstone.
Just the pre-IPO stage, so to say?
No. So I think that's a misnomer. There is nothing like pre-IPO stage and post-IPO. There are 3 types of, what businesses go through, which is venture, seeded an idea, they are scaling it up. Then there is growth. They require capital to reach to a particular level. And when they run out of ideas, right? So imagine a business family which has got into something, took it to its potential, what they could manage. Great. After that, they have run out of ideas what to do. It may require professionalization of the business. It may require entering into new geographies, or they may have liquidity needs. So, the business may be doing well. That is the place where we get our deal flows from. And at the size at which we operate, after adding value, which we'll talk about, I think, in the subsequent question when you would ask, we make them exit ready. So first, from a timing perspective, as everyone highlighted, you have to know beforehand where you are going to exit. So for us, each of these 3 aspects, we make sure that at least 2 of them, we do a dipstick that can we take our businesses either to IPO or can we do a strategic sale? Would there be enough strategic interest for it? Or if this is something that another financial sponsor would be attractive towards, at least 2 out of these 3 have to be met before we even make an investment. The thought of making our business ready for exit is something, again, which is on day one. Because we are controlling the outcomes, we know what strategic value add that we need to do. And we make sure that in the first 3 years of our investment itself, we keep our companies exit ready, which allows us to maximize on the valuation as and when the opportunity arises. I'll give you an example here. We had a business called Spot On Logistics. The thesis was that post GST, there will be a lot of interest in road express as people go out of pocket for GST, as the goods move out of their factory. They would want to keep the supply lean, and faster transportation is what they would care for, and they would be willing to pay a premium for a product, which is what I'm calling out as express road logistics, which is giving a particular SLA that it will be delivered on so-and-so date, so-and-so time, otherwise you can, your money will be refunded back. So knowing that something like this is going to happen, we backed a company called Spot On Logistics. In 3 years' time, we rode the industry growth. And Delivery, which was a large logistics company looking to go for an IPO, already the market leader on the B2C logistics side of things, wanted to acquire a road express B2B logistics. They came up with an offer which we couldn't refuse. And the result was that in 3 years' time, we exited an investment at 3.25x, 50% IRR. Now, had it been a minority situation for us, we would have to consult a promoter or someone that whether can we sell or not sell.
Correct.
Just another example of an investment which we held on for 7 years. So I'm just saying that 3 to 7 years and weighted average being 5 years is typically where we would operate. The 7-year case was of Sapphire Foods, which through a consolidation play, we aggregated 8 different franchisees of Yum brands. we saw that in public markets, we'll get a far higher value as compared to private markets. But that would mean that we'll have to wait it out for 1 or 2 year more because there is a lock-in that is involved as a promoter. But the outcome was again fantastic that we could generate a 7x multiple on investment, 35% IRR. So toggling between 3 to 7 years, such that weighted average is 5 years from a timing perspective.
Okay, wonderful.